If you're a parent of a prospective college student, this can be an extremely exciting and nerve-wracking period of time. On one hand, your child's taking a huge next step in their personal journey, and ultimately that's a reflection of the amazing effort and hard work that both of you have put in. At the same time, though, deciding how you and your loved one are ultimately going to be able to pay for college can be a stressful experience because oftentimes scholarships, grants, savings, income might not cover the entire cost of education, but this is where student loans come into play. The various types of student loans are going to have a different impact both now and in the future, which is why they lead to plenty of different questions from both students and parents. In this video, you're going to learn all about the basics when it comes to different types of student loans from start to finish. That way you can understand the different options that are before you, from learning how student loans work, how much you can borrow, ultimately what you're signing up for, and how that's going to impact you and your loved one down the road. For a little bit of background before we get started, my name is Brian Walsh and I lead the financial planning team here at SoFi. Even though I'm a certified financial planner, nothing I say today should be looked at as financial advice. Think about this more as high-level educations or guidance. Let's start with the basics. What is a student loan exactly? A student loan is essentially money that's borrowed for college that's going to be paid back with interest over time, and it's used to cover college-related expenses like tuition, room and board, transportation, lab fees, books, etc. And there are going to be two main options when it comes to student loans: federal student loans and private student loans. First, let's dive into federal student loans. Federal student loans are loans from the US government, and qualifying for federal student loans is going to start with the free application for federal student aid form, which is commonly referred to as the FAFSA. This is going to be filled out on an annual basis when you're applying for financial aid, and the form's going to open up on October 1st, but each school is going to have a different due date, so you want to pay attention to what that is. Everyone who's considering, looking at different financial aid for schools should be filling out this form, and then it's going to be sent to the schools of your choice, where the financial aid office is going to go back, crunch some numbers, and ultimately figure out if and how much you qualify for in the form of financial aid, and that could be grants, scholarships, work study, you name it. Next up, we'll be looking at how much you can borrow in the case of a federal student loan, and ultimately that's going to depend on whether you're an undergrad, graduate student, or if you're a parent. It's also going to be determined by your year in school and your dependency status. If what you're able to get from federal student loans is not going to cover all of your needs, then typically that's where private student loans would come into play. Private student loans are going to be an option to borrow money from private lenders that are not the government. Think about this as banks, credit unions, or any other sort of financial services company. With this type of student loan, the eligibility and really the terms are going to depend on the borrower's credit history along with other factors. There's going to be some differences in the limits, the requirements, things like that related to private student loans that are going to vary from lender to lender, but at a high level, the total amount borrowed is not going to be able to exceed the school's total cost of attendance. So now that we went over the basics between federal student loans and private student loans, let's dive into some of the helpful details that you can use as you evaluate the specific options in front of you and your family. Let's start off with some of the common types of federal student loans before we get into a couple common types of private student loans. First, from a federal perspective, would be direct subsidized loans. And those are going to be offered to the student. And essentially, they're going to be meant as a lifeline for students that have financial need. This type of loan, the government's going to pay the interest as long as the students enrolled at least half time in classes. So what they owe when they graduate would be the same as what they borrowed throughout the experience. The government's also going to pay the interest for a 6-month grace period after the student leaves school or after they graduate. These loans are only going to be available to undergraduate students who demonstrate financial need due to income levels or other factors. So ultimately, the terms of these types of loans are going to be generally more forgiving than other federal student loans, but there's also going to be a cap which can limit to the extent that they can be useful, and typically they're not going to be used to fund an entire college education experience. Second would be direct unsubsidized loans, and those are also offered to the student, but they are not based on financial need or financial stress. Typically, this is going to be the most common federal student loan that we see. It's available to both undergraduate and graduate students. So these factors mean that it's going to be a little bit easier to qualify, but there is a big difference. The government isn't going to pick up any of the interest on this loan like they would with a direct subsidized loan. So with this type of loan, your loved one's going to be responsible for both the principal amount and then any accrued interest from day one after they receive the funds, all the way through when they ultimately repay the student loan. That's why direct unsubsidized loans can cost more than direct subsidized loans over the course of the life of the loan. Third up for federal student loans, you'd have direct plus loans, which are offered to parents that are helping pay for their dependent child's undergraduate education. Financial needs not a requirement here, but unlike direct subsidized and unsubsidized loans, the borrower's credit is going to be taken into consideration when looking at these loans. Essentially, a borrower cannot have an adverse credit history. Also worth keeping in mind, the maximum amount that a government awards in each school year is going to be based on the total cost of attendance, which comes from the school, minus all other types of financial aid that the student may receive. One thing worth considering is that there's going to be loan fees when it comes to direct plus loans that's going to be proportionally deducted from each disbursement that the borrower receives. When you think about it, federal loans that a parent can take out, in this case direct plus, are going to have slightly worse terms than the loans that a student could directly take out through either a direct subsidized or a direct unsubsidized loan program. Depending on your family's financial situation, you'll likely want to take all these factors into consideration before choosing which option or options are going to be best for you. Next up, we have private student loans, and the first option here would be those taken directly by the student. Private student loans taken by the student can offer some different benefits. For example, they can ultimately mean the difference between being able to pay for school and not being able to pay for school, because oftentimes there's a gap between the total cost of attendance and what an individual is able to get from scholarships, grants, work study, and then any sort of federal student loans. Another benefit of private student loans would be that, generally speaking, there's a little bit more flexibility and control related to things like interest rates, both the amount and the type. So let's say, for example, a fixed or a variable interest rate. Additionally, private student loans may also have more choices when it comes to loan terms and repayment options. And some private student loans are either going to charge a fee or not charge an origination fee. So it's really important that you read the fine print to see what costs you may or may not be incurring along the way. One big downside of private student loans for students is that typically a cosigner is required. Generally speaking, there's not many high school or college students that have enough income or credit history to go through the underwriting process alone. So to qualify for a private student loan, they may typically require a cosigner. It's important to keep in mind that if you co-sign on a private student loan, you should really be aware of whether or not the lender offers a cosigner release, which essentially means that if your child makes a certain amount of qualifying payments, the cosigner would essentially be removed from that loan. Finally, we have private student loans that are taken out by the parents. These are essentially loans that are made by private lenders to the parent rather than the student. Sometimes these can be beneficial because they can offer different interest rates and more flexible repayment terms depending on the borrower's profile when it comes to credit, income, and other factors that lenders look at. As you can see, there are plenty of different options when it comes to student loans. Some of these differences may seem pretty nuanced right now, but many of them can have major impacts down the road, whether it be repayment options, lifetime interest, or even potential forgiveness. Ultimately, as a parent, as you're making this decision, it's critical to assess whether or not these student loans are going to negatively impact your own financial future. Especially as you get closer to retirement, keep in mind that there's not an equivalent to a student loan for your own retirement. So you'll need to weigh all of these different options, whether it be the types of student loans that are available, who takes out the student loans, and then how the repayment would impact you and your child before making these complex decisions.